Most traders look at a sideways range and see nothing. They see a dead time, a place to close the charts and wait for something to happen. That's the expectation for most traders. Here's the reality. Nothing happens in a range. The range is the plan. While retail is boring, smart money is quietly building a position, using your stop-loss orders above the highs and below the lows as the exit liquidity for their entry. The range isn't empty space between moves. It's the mechanism that manufactures the move. In the next few minutes, I'm going to show you the 3 dealing range types that make up every single price swing on any chart: the accumulation phase, the manipulation phase, and the distribution phase, and how to read which one you're standing in before price tells you the obvious way. By the end of this, you won't see a range as nothing happening. You'll see it as the setup. Welcome to Trader's Bible, the quiet room for market mastery. Let's get into it. Let's start with the piece almost everybody gets backwards, because if you get this one wrong, nothing else in this video will make sense. You've been taught that a tight sideways range is dead air, nothing to trade, a place where smart traders step away from the screen. And on the surface, that makes sense. Price isn't going anywhere, so why would you be interested? Think about how this belief actually gets formed. You open a textbook, or you watch a beginner strategy video, and the advice is almost always the same. Wait for a clear trend, avoid choppy price action, and only get involved once the market picks a direction. That advice isn't malicious, it's just incomplete. It teaches you to treat the absence of a big directional candle as the absence of activity. But absence of movement and absence of activity are two completely different things, and confusing them is the first mistake that sets up almost every other mistake on this list. Here's what's actually happening inside that range. Every time price pokes above the high and gets rejected, a cluster of buy stops gets left resting just above it. Every time price dips below the low and snaps back, a cluster of sell stops gets left resting just below it. That's not randomness, that's inventory. The range isn't failing to move, it's building the exact fuel it needs to move violently in one direction. I call this a Type 3 dealing range, and its entire job is to manufacture liquidity on both sides before the real move even starts. Picture a range that's been sitting between two levels for the last several hours. Every rejection off the top isn't just price failing to break out, it's a breakout attempt from a group of traders who bought too early, now sitting underwater, with their stop-loss resting just above that high. Multiply that by every single time price tests that level, and you start to understand why that high isn't just a line on your chart. It's a shelf of stacked orders. The same thing is happening on the low, except with sell-side stops from traders who shorted too early. Both sides of the range are quietly filling up with exactly the kind of orders a large player needs to fill their own position, without moving price against themselves. That's the part retail never gets taught. Big size can't just be dumped into the market in one go without slippage, so it needs pockets of opposing liquidity to trade into. A range is where those pockets get built. Here's where traders get hurt. The second price pushes outside the range, retail jumps on the breakout, because that's what every strategy course tells you to do. Buy the break, ride the trend. But that first push outside the range is very often the trap, not the trend. It's the exact liquidity grab I just described. You didn't spot a breakout. You became the liquidity that funded someone else's position. This is the part worth slowing down on, because it explains why so many textbook breakout trades fail almost immediately after entry. You see price close above resistance, you enter long, and within minutes the move reverses hard and stops you out, only for the real move to happen in the opposite direction shortly after. That's not bad luck. That's the range doing exactly what it was built to do. The initial push outside the range sweeps the resting stops on that side, fills the orders of whoever engineered the move, and then price reverses because the actual directional intent was the opposite side all along. If you're only watching for a breakout candle, you have no way of distinguishing a genuine expansion from a liquidity raid dressed up as one. They look identical in the moment. The only way to tell them apart is by understanding why the range existed in the first place. So the shift you need to make is simple to say and hard to actually do. Stop asking, is this range about to break? And start asking, which side of this range is being engineered to get raided first? Mark the high, mark the low, and treat both as bait, not boundaries. Once you see a range as a liquidity plant instead of dead time, you stop trying to predict the breakout and start waiting for the one thing that actually confirms it, which is where our next mistake lives. To actually apply this, get in the habit of marking both the high and the low of a consolidation the moment you notice price has stopped trending. Don't just watch the level closest to the current price. Watch both, because the range doesn't care which side you're emotionally attached to. It only cares which side has more resting orders to consume. If one side has been tested multiple times with clean rejections, and the other side has barely been touched, that untested side is often the one still waiting to be rated. This is a completely different way of reading a chart than which way is it about to break, and it's the foundation everything else in this video is built on top of. Because even once you accept that ranges are engineered, most traders then swing to the opposite extreme. They start trading the trend that follows way too aggressively, and that's point number 2. Once price does leave the range and starts printing a clean sequence of higher highs and higher lows, or lower highs and lower lows if it's bearish, you're looking at what I call a Type 1 dealing range. It's the expansion and retracement phase. And I'll be honest with you, it's the easiest pattern on this list to spot. That's exactly the problem. Because it's easy to see, it's also the pattern retail piles into the hardest. The trend is your friend gets repeated so often that traders forget to ask a more important question first. Is this trend actually aligned with what the higher time frame is doing, or is it a retracement inside a bigger move running the opposite way? Buy every dip in what looks like an uptrend on the 5-minute chart, and you can end up buying the exact top of a pullback inside a much larger daily downtrend. The chart felt obvious. The account didn't survive it. Here's why this trap is so easy to fall into. A retracement inside a larger bearish move can look, on a lower time frame, exactly like the start of a fresh bullish trend. Higher highs, higher lows, clean structure. Every visual cue your brain has been trained to associate with safe to buy is present. But zoom out 1 or 2 time frames, and that same sequence of candles might just be a bounce inside a much bigger down leg, the kind of pullback institutional sellers are using to add to their short position at a better price. The lower time frame doesn't lie to you exactly. It just tells you a smaller, incomplete version of the truth. And if that's the only version you're looking at, you'll keep mistaking retracements for reversals. This is why I treat Type 1 ranges differently depending on which side of the higher time frame narrative they're sitting on. If I'm trading with the dominant direction, the actual program the algorithm is running, I'll use full risk because the probability is stacked in my favor. But if I'm trading a Type 1 retracement against the higher time frame direction, I cut my risk in half automatically, no exceptions. Not because the setup is invalid, but because I'm borrowing probability I haven't earned yet. Easy to see doesn't mean easy to win. It just means everyone else sees it too, and that crowd is usually the exit liquidity for the bigger players riding the real trend. Think of it this way. When a setup is obvious enough that a large percentage of retail traders can spot it without much experience, that popularity is itself information. It tells you that a large pool of stop losses and take profits is about to cluster around very predictable levels, because everyone drew their lines using the same textbook rules. That predictability is exactly what a larger player can use against the crowd. The setup being textbook doesn't protect you. If anything, it makes you easier to model and exploit, because your behavior becomes forecastable the moment your entry logic matches thousands of other retail accounts doing the same thing at the same time. There's also a practical reason this matters beyond just avoiding the trap. If you can identify whether you're inside an aligned Type 1 range or a counter-trend one before you enter, you're no longer guessing at your position size after the fact. You're deciding it up front, based on where the probability actually sits, rather than deciding your risk emotionally in the middle of a trade that's already moving against you. That's a small mechanical habit, but it's the difference between a string of losses that stays controlled and a string of losses that snowballs into something much harder to recover from. Now, before we get into the reversal side of this, which is honestly where the most damaging retail habit of all shows up, if this framework is already reshaping how you look at your own charts, take 2 seconds and hit subscribe, tap the bell, and drop a like. It genuinely helps this channel keep putting out breakdowns like this one. and it means you won't miss the next part where we get into timing these setups with news catalysts. Alright, back to it. Here's a habit that's cost traders more money than almost anything else on this list. Shorting equal highs. Buying equal lows. You've been taught that when price taps the same level twice, it's resistance or support, and the textbook move is to fade it. Sell the double top, buy the double bottom. That belief comes from decades of classical technical analysis, and to be fair, it isn't baseless. Plenty of retail traders act on it, which means it can occasionally work simply because enough people expect it to. But relying on a level holding, purely because it held once before, ignores a much more important question. Who benefits from that belief being widely held? The answer, most of the time, is whoever is on the other side of all those fade trades. Smart money reads that same equal high completely differently. To them, it's not a wall, it's a magnet. Every trader shorting that level is placing a stop loss just above it, which means equal highs and equal lows aren't barriers. They're clearly marked pools of resting liquidity, sitting right there in plain sight, practically labeled for anyone willing to raid them. Consider what a chart actually looks like from this angle. Two swing highs at nearly identical prices aren't a ceiling, they're a target with a name tag on it. Because every trader who shorted the first touch and every trader who shorted the second touch has a stop sitting just above that shared level. The more times a level gets tested and holds, the more attractive it becomes as a target, not less. Because each test adds another layer of stop losses stacking on top of the previous ones. The very thing that makes a level look strong to a retail trader is the same thing that makes it more likely to eventually get swept. This is what I call a Type 2 dealing range. A reversal profile that's actually targeting those equal highs or lows, not stopping at them. Picture this. Price sells off, sweeps below a recent low, and then sharply reverses. Retail sees support broken and stays bearish, or worse, tries to short the bounce because it should fail. But if that reversal is sweeping sell-side liquidity and the market structure shifts on the way back up, you're not looking at a dead cat bounce. You're looking at price being delivered toward the equal highs sitting above, the exact level retail is convinced will hold it down. Walk through the full sequence slowly, because this is where most traders lose the plot. Price breaks a recent low, panic selling kicks in, because that's what a break of support is supposed to trigger. Then, almost immediately, price reclaims that level and starts pushing higher. A retail trader who's only trained to read price level by level sees this as noise, or worse, a trap to short into, because the bounce should fail. But if you're reading structure instead of just levels, if you notice that the sweep below the low was followed by a shift in how price is behaving, stronger closes, less hesitation, structure printing higher lows again, you're watching accumulation complete and distribution begin. The equal highs sitting above aren't a ceiling this move will struggle against. They're the destination this move is being sent to. The framing shift here is the one that actually changes your win rate. Stop treating equal highs and lows as places to fade price, and start treating them as destinations. When you see them, don't ask, will this hold? Ask, is this where the price is being sent? That single change in vocabulary, barrier versus magnet, is the difference between fighting the algorithm and trading alongside it. Now here's a subtler one, and it trips up even traders who've already learned the first three concepts. What happens at the midpoint of the range? Every dealing range has a fair price sitting exactly halfway between its high and its low. I call this equilibrium, or the 50% DRT level. Traditional teaching says price needs to retrace deep into discount or premium territory before continuing. Pull back 70–80% of the move before it's safe to enter. And sometimes that's exactly what happens. That expectation of a deep retracement gets baked into traders early, usually through classic Fibonacci-based strategies that treat the 61.8% or 78.6% level as the ideal entry zone. And to be clear, deep retracements absolutely happen. Plenty of legitimate setups do pull back that far before continuing. The mistake isn't believing deep retracements exist. The mistake is assuming they're mandatory and refusing to acknowledge a move until price has earned that pullback by your own arbitrary standard. But traders get burned assuming it always has to happen. When the algorithm is delivering price aggressively, when you see strong-bodied candles pushing cleanly through equilibrium without much hesitation, that's a signal the market has no interest in giving you a deep discount. It's telling you, right there on the chart, that it's already imbalanced in one direction, and it isn't waiting around for latecomers. The visual cue here is worth learning to recognize on sight. A shallow pullback that barely dips below equilibrium, followed immediately by strong-bodied continuation candles with minimal wicking, is telling you something very different than a slow, choppy grind back toward the 50% level. The first is conviction. The second is hesitation. If you're waiting for the same depth of pullback on both, you'll miss every single one of the aggressive moves, because by the time price earns your entry criteria, the move has already extended well past the point of a favorable risk to reward. So here's the framing. Equilibrium isn't a checkpoint you wait at. It's a pivot you react to. If price explosively closes through the 50% level and leaves behind a clean, balanced range or a fair value gap on the way, that's your cue to shift bias immediately, not to sit on your hands waiting for a pullback that respects the rules. The traders who miss the biggest expansions aren't wrong about the levels, they're just waiting for a retracement that was never coming. Which brings us to something almost nobody in retail trading talks about, and it might be the most underrated piece of this entire framework: timing. You can have the cleanest Type 3 range, perfectly marked equal highs and lows, textbook equilibrium, and still watch price do absolutely nothing for hours. That's because price levels don't operate in isolation. They need time to align with them. High and medium impact news releases aren't chaos to avoid trading around. They're closer to a scheduling mechanism, the moments the algorithm actually uses to release price out of consolidation and into expansion. This is the piece that most price action-only traders leave out entirely, and it's costly, because a level without a catalyst behind it can sit untouched for an uncomfortably long time. You can have every single concept from this video mapped out perfectly on your chart and still watch price wander sideways for hours if there's nothing scheduled to actually force participation into the market. Liquidity needs a reason to move with conviction, and low-volume hours simply don't provide one, no matter how clean your technical picture looks. Trade a perfect technical level during a dead overnight session with no catalyst nearby, and you'll often just get chopped. Price wicks your stop and goes nowhere meaningful for the next hour. That's not the setup failing, that's the setup being early. The same exact level, tested during a high-impact release or a major session open, behaves completely differently, because that's when there's actually enough participation to deliver price with conviction. Think about the difference between testing a level at 3 in the morning during a quiet Asian session versus testing that same level in the minutes surrounding a major data release or a London or New York Open. The chart pattern might be identical in both scenarios. The outcome almost never is. During low participation hours, there simply isn't enough volume behind any single push to sustain a real directional move. Price can wick through a level and snap right back, stopping out anyone who anticipated a clean break. During high participation windows, the same test of that level has actual weight behind it, because enough market participants are engaged simultaneously to either respect the level or blow through it with follow-through. So the practical shift is this: don't just map price. Map price against a calendar. Know when the session opens and the major data releases are landing relative to the level you're watching. If your key DRT level is sitting untouched heading into one of those windows, that's not a coincidence to ignore. That's often exactly the moment the range is designed to break. And once you put all 4 of these pieces together, the range, the trend, the reversal, and the timing, you start to see that the market isn't actually doing very much at all. It's cycling through the same 3 phases, over and over, on every single time frame. Accumulation, manipulation, distribution. A Type 3 range builds the liquidity. A Type 1 range sweeps it and expands. A Type 2 range reverses and delivers price to the other side. Then the cycle starts again, one level up or one level down. What makes this cycle so powerful to understand isn't just that it happens once on a chart, it's that it happens fractally, meaning the exact same 3-phase structure repeats on every time frame simultaneously. A Type 3 range on the monthly chart might contain dozens of complete Type 1 and Type 2 cycles on the hourly chart nested inside it. Once you can hold that idea in your head, you stop looking at a single chart in isolation and start recognizing that the 5-minute range you're staring at right now might just be the accumulation phase of a much larger move still building on the 4-hour chart above it. Most traders lose money because they jump in during the middle of this cycle, chasing the expansion after it's already extended, buying in during distribution when smart money is already offloading into them. Once you can map accumulation, manipulation, and distribution fractally, from the higher time frame down to the lower time frame you actually execute on, you stop reacting to price and start anticipating which phase it's about to enter next. If you're sitting there thinking, I understand this, but I still won't execute it under pressure, that's not a knowledge gap, that's a systems gap, and it's the exact thing the complete trading system was built to close, from the risk rules down to the post-loss protocol that keeps one bad trade from becoming 3. It's linked below if you want the structure instead of building it the hard way. Knowing the cycle in theory is one thing. Watching it repeat, phase by phase, on a real chart is where it actually clicks. So look closely at what's on your screen right now. So let's go back to where we started. You came into this thinking a sideways range was dead time, a place where nothing was happening, and the real trading started once price finally broke out. You now know that's backwards. The range was never empty. It was the plan. Every high that got tapped and rejected, every low that got swept and reclaimed, that was inventory being built, not noise being ignored. The breakout you were waiting for wasn't the start of the move. It was already the middle of someone else's. That's the shift. Not a new indicator, not a new strategy, a new question. Instead of asking, where is the price going to break, you're now asking, who is this liquidity being built for, and which direction does it get delivered? Consolidation as manufactured liquidity. Trend continuations that only earn full risk when they align with the higher time frame. Equal highs and lows as magnets, not walls. Equilibrium as a pivot, not a checkpoint. And time, the piece almost nobody accounts for, deciding when all of it actually gets released. None of this requires you to predict the market. It just requires you to stop reacting to the obvious move and start recognizing the one being engineered underneath it. Sit with that before you open your charts again. The range you've been ignoring your whole trading life was never asking you to wait it out. It was asking you to read it. Every single concept covered here started from the same place, a chart most traders had already dismissed as nothing worth watching. This has been Trader's Bible, the quiet room for market mastery. If what you just watched changed how you'll look at your next chart, that's the theory. The complete trading system is the execution side of it, the rules, the risk framework, and the post-loss protocol that turn, I understand this, into, I actually did it. Links below if you're ready to stop trading the obvious move and start trading the engineered one.